the U.S. stock market breaks, the money will flow like blood. Okay, it will go somewhere else. It always does. You go back and look at history for the last 100 years of major stock market declines, you could find something where it was a better place to be. Not just better, but good place to be. And that's monetary metals, gold. The money will begin to flow, and it'll go to the two traditional safe places, gold and related, and T-bonds. Gold did well. Gold did well for 11 years then, from 2000 to 2011. 2007 top to the 2009 bear market low. Gold did well, with the exception of 1 month in there.
As 2024 ends, Wall Street celebrates another year of remarkable growth. The S&P 500 has climbed approximately 25%, while the Nasdaq Composite has soared by about 31%, continuing the robust momentum seen in 2023. Investors with diversified portfolios have enjoyed significant returns as major indices reach new record highs. Meanwhile, Japan's benchmark Nikkei 225 stock index is poised for a historic year-end close, surpassing a peak last achieved 35 years ago during the nation's 1980s economic boom. Financial analyst Michael Oliver has predicted that the U.S. stock market is amid an unprecedented historic bubble. He explained that once this significant U.S. asset class breaks down, capital will flow like blood to safer havens, as historically, with monetary metals like gold often emerging as the favored choice. Gold set records 40 times annually in 2024, with total demand surpassing $100 billion for the first time in the third quarter. Factors such as geopolitical risks, central bank purchases, and the U.S. Federal Reserve's rate cut cycle are expected to sustain gold's appeal into 2025. The World Gold Council report shows that gold is on track for its best annual performance in over a decade. However, market consensus on key macroeconomic variables, such as GDP growth, suggests that while gold may continue to grow next year, the gains will likely be more modest compared to 2024. Michael Oliver noted that money has already begun flowing into gold and silver this year. Despite occasional pullbacks, he emphasized that gold remains a viable long-term alternative for investors seeking stability and value. Join us as we dive into the video for a deeper look. Don't forget to subscribe and click the bell icon to stay informed about our latest updates.
Gold, monetary metals this year. Okay, now we've been arguing that once that massive asset class of the U.S. stock market, and by the way, there's a couple that are in sync with us, Nikkei and Sensex in India. Nikkei in Japan, since they equally look like big bubbles, and they're very close to technical levels that we define via our method. We argue that once the U.S. stock market breaks, the money will flow like blood. Okay, it will go somewhere else. It always does. You go back and look at history for the last 100 years of major stock market declines, you could find something where it was a better place to be. Not just better, but good place to be. And that's monetary metals, gold. Sometimes, in fact, many times, T-bonds have also been a good place to be. You go back and look at the .com top through 2002 low, bonds did well. Gold did well. Gold did well for 11 years then, from 2000 to 2011. 2007 top to the 2009 bear market low. Gold did well, with the exception of 1 month in there, and T-bonds did well. This time around, it's going to be different. This time around, a lot of people know we have a government debt crisis, and it can't just be wished away. New president can't wave a wand and it goes away. It will cause hemorrhaging. However, we see technically the potential that once the stock market starts to crack in a way that upsets major asset managers and smart investors, the money will begin to flow, and it'll go to the two traditional safe places, gold and related, and T-bonds. However, any T-bond rally you see, while it could be enjoyable for, let's say, a quarter of a year, maybe several months, as money flows out of stocks into T-bonds, it's not going to last. In other words, the guys who analyze T-bonds as a major bear trend, higher rates, are correct. The problem is we see the potential for a counter-trend rally in T-bonds that could upset those people's notions. Not that their notions are wrong, just that there's going to be a counter-trend rally. I think there's a good potential for that. However, don't confuse that with gold as being a viable alternative. So we think that the key now for gold and the key now for the T-bond market is the breakage in the stock market. So if you're in gold, look at the stock market. Okay, because when it cracks, the blood's going to flow and it'll flow quickly. We have a massive historic bubble in the stock market in the US by all metrics, duration of time, percentage gains, uh, et cetera, et cetera. There's only two other markets in the world that compare, and that's the Sensex in India and the Nikkei in Japan. Europe doesn't compare. China is certainly not a bubble. It's barely, not even twice, I don't think, what the price low was in 2009. You know, when they made a low coincident with us, they're only double. We're like 8 to 9-fold in the S&P and 18-fold in the Nasdaq. So, but when it breaks, the money will flow, and it will flow into those categories. And if your objective measure just of simple price, you can see, hey, it's been flowing this year. Why? Because gold and silver are up as much as the stock market. Nobody's touting that, but because we get pullbacks constantly in gold and silver. And yet year to date, and possibly in 3 more trading days, they'll be up more than gold, than the S&P and the Nasdaq year to date. So money is already beginning to flow, but it'll begin to flow more noticeably and in great volume once you punch a hole in the stock market. And we do see the technical triggers for that literally a couple percent below where you're trading right now.
Despite challenges from inflation and rising interest rates, the U.S. economy displayed impressive resilience in 2024. GDP is projected to finish the year at 2.8%, bolstered by steady consumer spending and strong job growth. The unemployment rate has remained stable at 4.2%, while inflation has significantly declined from its 2022 peak of over 9%, now resting at 2.7%. The Federal Reserve's monetary policy will be critical in shaping market trends. Although markets are pricing in 225 basis point rate cuts for 2025, Fed officials have expressed caution. Michael Oliver believes a significant shift is underway, reminiscent of the late 1970s when soaring commodity prices accompanied stagflation and rising interest rates. He anticipates that in this cycle both commodities and gold are set to rise in tandem, driven by the broader economic environment and shifts in capital allocation. Now, let's redirect our attention to a video.
And ultimately, the government doesn't control things. I mean, it likes to nudge things, poke things. Hopefully the Fed likes to think they can take this price, hold this price level steady in this category and let that one go down. They don't like commodities going up. That kind of inflation is bad. But they don't mind when inflation drives stock prices up because they don't call that inflation. And yet it's nothing but a river flow of money they created. It went somewhere else other than the commodities. Right. Well, that flips. You go back to the late 70s, we were in a recession. Stagflation. Fed raising rates dramatically in late 70s. Commodity prices were exploding. Well, the stock market was a total wasteland. No, they didn't explode as much as gold, but they went up strongly with gold. And I think this time around, they're set to go with the next power leg in gold. I think commodities are set to participate. And they've not always been in sync with gold at all. Sometimes they're quite opposite. In fact, over the last couple of years, gold doubled from 2015 bear market low to 2020, doubled in price. During the same years, Bloomberg went down. When did Bloomberg explode? After gold had peaked and went sideways, Bloomberg then exploded. Okay, totally out of sync. The last couple of years, Bloomberg's drifted down, about a 50% correction back to its bear lows and then gone sideways. Gold's gone up. So, but I think they're now set technically to hold hands and go together. Why? Primarily because the money will flow out of the massive asset category into that which is perceived to be low risk, higher reward.
Could gold be looked at as a smart money indicator?
The gold is not some headline chasing market. In fact, if you sell gold or buy gold based on some kind of war news or some kind, the election outcome news, that kind of thing, it's likely to blow up in your face. So if you shorted after Trump got elected, you're losing in gold, as much as $100 right now. So you don't do that. Gold moves on broader glacial reasons. And again, look at an M2 chart, go back 50 years and take a look. The gold will oscillate that money growth, but it'll stay in tune with it. They degrade the money, gold's going up. And if they have more excuse to degrade the money because they need to hopefully stop price collapse in this sector or that sector, banks, financials, commercial real estate, they'll do so when the chief beneficiary is the monetary metal because it is money. And it's been that way for 3,000 years. We may have forgotten about it, but a lot of the world hasn't. And I think suddenly when the American public, which is not at all bullish on gold, despite its strength year to date, they're not pounding the table. There's no fever in the gold market. That's when you'll see gold start to go more parabolic. Instead of like 3 steps up, 1 step back, it's going to be more like 6, 8 steps up, 2 steps back. And silver will be even more exaggerated. It goes up 4 and drops back 2. It's a bloody market. Yet year to date, silver's up, about as much, if not a little more than the S&P. In fact, in 3 days, maybe it'll be up more than the S&P. So it's not a loser from an investor's perspective if you get in at the right spot. So that's what I'd be looking for. And I think it is smart money. Obviously, somebody's buying it, and it's not just the Chinese. There are large American investors who've been buying into that sector.
As 2024 concludes, it's an opportune moment to reflect on a year that challenged and rewarded investors in equal measure. From significant policy shifts by central banks to dynamic sectoral trends, the markets offered a mix of caution and opportunity. Analysts highlight that fluid global economic conditions, alongside heightened demand for gold by central banks, played a crucial role in driving up the precious metal's value. Reports reveal that central banks worldwide collectively added over 500 tons of gold to their reserves in 2024, underscoring the metal's appeal as a reliable store of value. As gold prices surged this year, what key trends might sustain this momentum into 2025? Join the conversation. Share your thoughts in the comments, give us a thumbs up if you found value in this video, and subscribe to stay engaged with our community.